Hey everyone, this is Rob with DuncanFundingPartners.com. I'm a certified financial planner with a background in neuroscience, and we help our clients build, preserve, and transfer their wealth. Today we're going to take a look at asset allocation and how some of the largest U.S. banks invest their capital strategically. And so we're going to take a look at two of the largest balance sheets of the biggest banks in America. Now, banks are highly regulated institutions, and part of their fiduciary responsibility requires them to upload this information every quarter. So if you're curious, you can access all the information I'm going to go through today by going to fdic.gov. So we're going to keep the exact names private, but what I can tell you is that this is a very patriotic bank. And the definition of a balance sheet is assets and liabilities, what the bank owns and what it owes. And coming straight to the chase here, so we'll see total assets 1.73 trillion, total liabilities 1.52 trillion. And if we cut straight to the chase here on line 41, what we'll see here is life insurance assets. And now I don't know anyone who calls their life insurance an asset, but for some reason the bank does. And if we take a look at that figure associated with that asset, it looks to be pretty huge, just over $21 million. But if we actually scroll up to the top here, this says dollar figures in thousands. So we have to multiply this number by 1,000. And so the total is actually $21 billion in life insurance assets. And if we compare that to a more popular asset, let's say real estate on lines 10 and 11 here, we'll see that the bank actually owns just under $9 billion in real estate. So they've got twice the amount in life insurance assets. So why, you ask, do banks invest more in life insurance assets than in real estate? Well, let's take a look at some of the top 5 reasons here. And starting with number 1, it's just going to be the growth rate. Banks can get a much better growth rate from life insurance policies than they do on things like CDs, short-term bonds, and money market accounts. And many of these policies are actually structured so that they're taking zero market risk. That means that these policies don't take any stock market losses and instead provide steady year-over-year growth. Second is going to be the tax benefits. So because the United States government deems life insurance to provide a social good for widows, orphans, and failing businesses, they actually don't tax the inside buildup of cash value life insurance policies. So what do you get with that is tax-deferred growth, tax-free income, and a tax-free death benefit. And so if you're familiar with a Roth IRA, this is tax similar to a Roth, but if you know about IRAs, you know that IRA actually stands for Individual Retirement Account. And of course, the bank isn't an individual, so this is how they get around that. I'll make a separate video explaining these tax codes that enable banks to do this. Number 3 is going to be liquidity. So in order for the $21 billion figure to show up on the balance sheet and qualify what's known as Tier 1 capital, it has to be fully accessible by the bank to access for any reason and at any time. And most people don't actually know that even retail policies can be structured the same way the banks do it, and it can be an asset on the balance sheet. But it does take a life insurance professional or firm who knows exactly how to do so in setting that up. The 4th benefit is protection, key person death benefit protection. So because this is life insurance, if one of the insured was to die, the owner of the policy, in this case the bank, would collect a death benefit tax-free. Now, this might seem a bit morbid, but the average cost of replacing a key executive is 5 to 7 times the annual salary. Now, most would agree with me that this is less important in a big corporation like a bank, but more important for a family-owned business or a family breadwinner to make sure that their family and their business is taken care of if, God forbid, something happened to them. So the 5th and final benefit we've identified are the generous funding limits allowed by the IRS in these life insurance plans. So these plans are called bank-owned life insurance, and they're actually tied to deferred comp agreements for key executives. But these executives are already limited to the maximum they can contribute to their 401k. And let's face it, if you want to put money in a Roth IRA, there's even lower funding limits. And if you make too much money, you can't even contribute to a Roth. Not so with life insurance plans. So to recap, here are the top 5 reasons why banks invest more in life insurance assets than real estate. And to show you that this isn't an anomaly, here's another one of the top 3 US banks. And if we just pull up the balance sheet, we'll see 1.78 trillion in assets, 1.6 trillion in liabilities. If we scroll down to line 41, they've got 19.4 billion in life insurance assets. And if we take a look at lines 10 and 11 real estate, it's 11.1 billion. So just about double again in life insurance assets. So what I'm saying here is not to stop investing in real estate, but also consider another asset class that you can leverage and use intelligently and has some better tax benefits attached to it. So thanks for watching, and check out some more of our content on DuncanFundingPartners.com as you further your wealth building education.